Good day, and my name is Pruksa Iamthongthong. I'm the Senior Investment Director on the Asian Equities team. Today, I'm going to talk about the outlook for the next quarter for Asian equities. We see four key focus areas going forward. Firstly, on rising recession risks. The key change this quarter is that we are seeing that concern on rising recession risks have actually increased and has been brought to the forefront, particularly in developed markets. Our macroeconomic team has forecasted that the US will tip into a recession in the later part of 2023, and this is their baseline scenario with a probability of 35%. The reason behind this is that with the high inflation that we are facing currently, rates actually needs to be higher and unemployment will need to be higher to actually bring some of these challenges that we are facing down. On the other hand, what we are seeing is that supply side pressure is actually starting to ease. Even though China had an Omicron issue, we are actually seeing that that has not really derailed the supply chain recovery. So perhaps as we look forward, we will continue to see supply chain starting to ease, and that will help with some of the pricing pressure that we are facing currently. That said, we are already seeing some of the slowing growth coming through with developed markets PMI, which stands for Producers Manufacturing Index, showing a decline since April, while in emerging markets, we are seeing the opposite trend. Secondly, inflation. The last quarter, we talked about how inflationary pressure is hitting up in developed markets. This quarter, one of the key changes that we are starting to see is that this is coming through in Asia as well, with India and the Philippines at the high end of the spectrum, while China and Thailand is at the lower end of the spectrum. That said, when you put everything into perspective, inflationary pressure in Asia is relatively lower than the developed markets, and we believe that from a macroeconomic and monetary policy perspective, rates should remain relatively more supportive for Asia as growth continues with the reopening of Asia. Thirdly, China. Due to the lockdown impact that we have felt in the second quarter, China's GDP only grew 0.4% year-on-year during that period, and this is also below consensus. The reason why there was this weakness is really because of the sequential decline that we see in April and May. And to put things into perspective again, based on our internal China activity indicator, the 2 months drop that we saw was about half of what was recorded in 2020 when the COVID effect first broke out in China as well. The industry line, as represented by the industrial production, has actually recovered most of their lost ground in May. But what we saw was that in retail, that hasn't really recovered. When we look at the latest June numbers, retail has also shown a strong recovery. While it is likely that China will maintain a zero COVID policy until year end, we are also seeing signs that the policy has become more dynamic, and companies and consumers, more importantly, are also adjusting to the plan to minimize the disruption in the event of future lockdowns, which we believe that will be of a shorter duration and to be less disruptive going forward as well. Finally, India. India's recovery is on track. GDP is back to pre-virus level, and we expect to see domestic demand and investment to continue to strengthen. However, we talked about the global recession scenario just now, and like many economies, India will not be immune to that. External demand weakness and tighter financial market conditions will no doubt weigh on India's growth. That said, the unique thing about India is that it has a large domestic market, with export comprising only 10% of its GDP. So we do expect it to be relatively more insulated and relatively more resilient. As always, India is not without its challenges, and the core inflation, as we have mentioned just now, is running pretty high, and as a result of the rates environment that India is in, currency is also coming under pressure. So far, we expect the central bank to hike rates on a relatively gradual basis. We are not seeing a dramatic tightening scenario on the horizon, but that's an area that we are monitoring pretty closely. In summary, we are entering into an increasingly challenging global environment, though relatively speaking, we expect Asia to be better positioned, whether we look at the challenges around growth or challenges around inflation. More importantly, what this means is that the focus on the quality of the company is of utmost importance, and the focus on earnings resilience of these companies that we invest in is something that we pay attention to as the overall operating environment becomes increasingly difficult. When we look at China, which is a large part of Asia, it is in a different rate cycle than the rest of the world, and it also has a strong ability to do counter-cyclical measures. While in India, we talked about just now, the other big market in Asia is also relatively more insulated. Against this, valuation is looking increasingly attractive. The MSCI Asia Pacific ex-Japan Index is now trading at below its 10-year historical average at 11.4 times, and it is slightly above its recent COVID trial as well.